One of the biggest reasons for you to go and diversify your property portfolio is because you want to avoid having to pay land tax. Now, this could be a tax that you haven't experienced yet, or you're someone who owns property in the same state and now you're having to pay an extra tax which no one really likes. So in this video, I'm going to share with you exactly what the land tax thresholds are when it comes to every state here in Australia, and then how you can overcome having to pay for an unnecessary tax so you can go and maximize your profits. If you're interested, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, the truth is that when you go out and buy real estate, there are a lot of costs that are involved. Some are upfront and then there are others that are ongoing. What we're going to focus on in this video is around land tax and how it differs state to state. And it's very important you know this. Because while you think you could just go out there and just buy property in the same state and continue to buy in that state, you're going to start racking up a large tax bill. Now, what may sound really small early on can actually be quite large over time. And that's why it's important that you have the right strategy when purchasing property. Now, I'm going to use my example. I've got a property portfolio around 15 to 16 mil at the moment, and I've got properties across 4 or 5 different states. Now, if I had all of those properties in the one state, I could find myself having to pay anywhere in excess of $50,000 to $60,000 in extra tax that's unnecessary. Now, why I say it's unnecessary, very similar to stamp duty, I think there's a better way to be more efficient with how tax is charged here in Australia. That is a completely different argument, and I'm definitely not covering that off in this video. Now, of course, tax is something that you have to consider, but it is a byproduct of buying property or investing. So what you want to focus on is getting the high growth properties, knowing that it fits in your overall strategy, and then have to consider other things like depreciation, how much tax do I have to pay, and then things like land tax and other costs involved. So let's go through what exactly land tax is, how it's calculated, and how it differs state to state. Land tax is a state-based tax, and it's based on the value of the land that you own in that specific state, and you're charged that land tax after you hit a particular tax-free threshold. This is complete tongue twister, but I'm going to try my best to get through this video. Now, what the land tax threshold is that once you hit that number, every dollar after that you own in terms of value of real estate, you will then have to start paying land tax. And I'm going to use an example so it makes it super clear. Now, as I mentioned, land tax differs state to state. So I'm going to try my best to cover off all the major states, and we'll go across to New South Wales first. I'm here on revenue.newsouthwales.gov.au, so you can access this as well for yourself. But what we want to know is who is actually paying land tax. So you may have to pay land tax if you own or jointly own vacant land, including rural land, land where there's a house, residential unit or flat being built, a holiday home, an investment property or properties, company title units, residential, commercial or industrial units, including car spaces, commercial properties, including factories, shops and warehouses, land leased from state or local government. Now, you will have to pay additional land tax if you are deemed a foreign owner for land tax purposes, and land tax will apply irrespective of how much you earn. And that is very important because you could go and buy property today and then lose your job, you will still have to pay that land tax. It's not like your pay-as-you-go income, where your income tax is dependent on how much income you make. If you own property and you own land that is exceeding the value of that threshold, you will have to pay land tax. So how exactly is it calculated and what are the thresholds here in New South Wales? Well, it does change year to year, so it continues to increase. But from 2024 onwards, the land tax thresholds will appear as follows. The general threshold is $100 plus 1.6% of land value above the threshold, up to the premium threshold. Premium threshold is $88,036 plus 2 cents of the land value above the threshold. Land tax is applied for the full year following the taxing date of 31 December and no pro rata calculations applies. So what we've got to do is we look at general first and then we head over to premium once we get to those numbers. So under the general threshold, you can have up to 1.075 million in terms of land value outside of your principal place of residence. And this is important. I know I have a lot of viewers that are watching that have their own principal place of residence, hold a large portion of value in their land, and you're going, am I going to have to pay tax on my own property? And no, you don't have to. You are paying this on investment properties. So your owner occupier is exempt from this calculation. But let's say you go and have 2 properties and the land value equates to $1.1 million. You would then have to start paying land tax, an additional cost that will start affecting your actual cash flow. And what they have there as the premium threshold is above 6.571 million. There's going to be very few people watching the channel that are in that boat, but it's just important to note that there are those two thresholds. Now, why is it important that we're making this video now? A lot of people have avoided buying in Victoria specifically because their land tax rules actually changed. So what I want to go through is what is happening in Victoria and what the changes actually are and what my thoughts are, whether it's something that you should consider as part of your decision-making process. So the general land tax rates in Victoria, where your taxable value of the land holdings under $50,000, you pay nothing. When you get from 50 to 100, it's $500. From 100 to 300 is $975. Then when you get to 300 to 600, it's about $1,350 plus 0.3% of the amount, more than 300K. And we'll use an example to bring it all home. Then 600 to a million is 2,250 plus 0.6 of the amount, above 600K. Then 1 million to 1.8 million, then 1.8 to 3 million, and then we have 3 million and over. Now, why so many people would go, well, if I don't have to pay land tax, I may as well just buy in New South Wales because they have a land tax threshold up to 1.035 million. So why would I go and purchase in Victoria when in reality, as soon as I hit 50,000, I'm pretty much having to pay land tax? Now, if you're purchasing real estate in Victoria and it happens to be a house, you're most likely going to hit that first tier very, very quickly. Now, I have some property in Victoria as well, and so I'm having to pay land tax, but I'm okay with that. And this is where it comes down to the advanced strategy, where most people will look at this number and say the land tax threshold is better in New South Wales, plus the stamp duty is lower in New South Wales, so Victoria doesn't really make sense because the stamp duty is the highest across the country. So for that reason, I'm not investing there. But in the bigger scheme of things, having to pay an extra $1,000 or $2,000 for a property that you could buy under market value plus is in the right point of the growth cycle will mean that it will outperform net when you look at your entire portfolio. When I say net, I mean after all costs, once you go and deduct all your deductions as well as the cash flow position and you look at the growth and see how much your net worth has actually grown, you're going to find that some areas of Victoria are going to outperform some areas of New South Wales. An example for this would be, say, if you purchase something for $500,000 in New South Wales or in Victoria and you find that the one in Victoria is growing by 2% higher annually than the one in New South Wales, you're going to find that it's growing by $10,000 tax-free every single year and it's going to compound more, which means you're going to offset any of those extra land taxes that you're going to have to pay anyway. Now, yes, it should be part of your consideration. If you're going to go out there and purchase 1, 2, 3, 4 properties all in Victoria, now you're going to find yourself having to pay quite a bit. And the reason I don't like that is not because of the land tax solely. Yes, it's an added thought, but the real reason is because of diversification. When you're focusing completely on real estate and you do it really well, you're going to make a lot of money. But what you want to do is you want to diversify within real estate. So when you're building out a portfolio, what you should realistically be doing is say 1 or 2 property purchases in the same state or same area. Then you want to go hop over into another state. And what this does is it means that when rules get changed in a particular state, you're not completely affected and out of the market. Consider this, if you were in Victoria and you had property there and you were having to pay no land tax or very little land tax because again, the rules had changed only recently, at that point you would have been saying, yeah, things are all right. But as soon as rules get changed like this, your bill could go from suddenly $1,000 a year all the way up to $15,000, $16,000 depending on how much real estate you own. And so that is the sort of change that could happen and is why it's so important that you diversify. Because even if a change like that happened, which it has in Victoria, I don't have my entire net worth and my entire portfolio in Victoria, which means I only had a real small bump up in terms of how much I had to pay in land tax because I had property in Western Australia, New South Wales, Queensland, and South Australia. But I know a lot of investors only look at the state that they live in. And this is where one of those big issues pop up when you're trying to scale up a big portfolio. When we go across to Queensland, individuals have a threshold of up to $600,000. It starts at $500 plus 1 cent for each dollar above 600K, then increases on a tiered basis for land valued above $1 million. It's different when you've got property in companies and trusts, and I know trusts are the hot topic at the moment, so people purchasing under trusts. And in that case, your threshold is actually lowered in Queensland. In most of the other states, if not all of them, if you purchase under a company or a trust, you're most likely having to pay land tax from day one. There is no threshold. And these are some of the things that you need to consider if you are going to go down the path of purchasing property under a different structure. Again, I am by no means an expert when it comes to these sort of things. I'm not licensed to talk about these things. So if you need help, contact us. I will point you in the right direction so that you can have conversations with accountants that know how to structure your finances properly so that you can go out there and build a large portfolio. In South Australia, the threshold is $732,000, and in Western Australia, it's $300,000. When you come into Tasmania, it's about $125,000, and in the ACT, it's a bit different. Over there, they have a fixed charge. There are no tiers. It's $1,612 that's paid regardless of the land's average unimproved value. Now, these numbers may seem really small at first, but if you hold a property for over 20 years, you can see the value continue to increase and you will see your land tax bill also increase. But I will always urge you to go and look at it like a business. If you go and put all of your income on one side, all of your expenses on the other, you look at the growth, you look at the cash flow, and then at the end, you need to see what your net number actually is. And what you see is that if you can get into the high growth markets, it doesn't matter what these other costs will look like. You need to focus on the bigger picture. You need to be entering markets when the growth cycle is right for you as part of the property cycle. And a classic way to know how this worked is that we were buying property in Perth for like 250 to 300K in 2020 and 2021. Now, obviously everyone wants to buy because the market's moved up so quickly. What you want to do is get into the markets at the right time. And I know there's a saying, time in the market beats timing the market, but if you can go and time the market as well as be in the market for as long as possible, you're going to set yourself up from word go that you've now minimized your downside risk and you've maximized how long you can hold that property because you probably got in at a lower price. Your cash flow looks a hell of a lot better after year 2 and year 3. And you're avoiding this whole concept of blue chip areas. Where you need to focus on are blue chip areas defined by supply and demand. And that's the sort of stuff that we deep dive into. We have a full-blown research team when it comes to that. I don't share as much here in terms of metrics and everything else because the reality is there are people in the company that do it so much better than I do. And I think you guys would get bored with that. So if you need help in data-driven research when it comes to purchasing property and having it done for you so you can get into the market with speed, then definitely contact searchproperty.com.au. That's the buyer's agency I run. We have over 40 full-time staff and we are absolutely loving life helping so many of you guys. If you guys need help, definitely reach out. And if you've enjoyed this video, hit that like button and subscribe if you haven't already. I'll catch you guys in the next one. Thanks guys.